Good afternoon, guys. Tony DeNaro here. Well, not a great day in the market today as Chairman Powell spoke in front of the Senate Banking Committee. Indexes plummeting today as he spoke. We're going to talk about that news, and I'll highlight just a couple of key points to you. You know that economics is kind of my nerd thing, and I like to explain that to you guys so you have an understanding why the indexes are moving the way that they move and what to expect for the remainder of this year. So let's dive into it. The Dow down 574 points today. That's 1.7%. Now putting the Dow in negative territory for the year 2023. The S&P down 1.5%, NASDAQ down 1.25%. Up here in the top left, you can see the decliners heavily outweighed the advancers in the market today. Decliners 44.53. Advancers 18.43. And as those indexes plummeted, the U.S. 2-year Treasury was shooting up, hitting its highest level since 2007. Look at this chart. Over 5% today on the 2-year Treasury. So what exactly did Chairman Powell say that spooked the markets this bad? Let's take a listen.
As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time.
This is what the market did not want to hear. 3 main points there. Economic data is continuing to come in stronger than expected, which means the Fed must act. This is a very clear signal to the market that things might not go as expected at the upcoming FOMC meeting on March 21st and 22nd. The market had been expecting a 25 basis point rate hike. Chairman Powell signaling today that it may go as high as half a point. The other thing that the market might be worried about is that the terminal rate might actually end up being higher than expected. The terminal rate being the peak federal funds rate. Again, Chairman Powell will be speaking tomorrow, Wednesday, in front of the U.S. House Financial Services Committee. So we have that to look forward to. Also, on Friday, we have both the employment report and the U.S. unemployment rate. February data will be hitting pre-market. So these are things to keep an eye out for in the economic front, things that are going to continue to shape the overall market for this week.
The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals.
There was a total of 2 hours that I listened to today, questions and answers from the senators back and forth with Chairman Powell. I'm going to save you from having to listen to all of that. But if you got 2 extra minutes, I selected 2 interesting clips that I want you to listen to. The first is Senator Warren. Now, Senator Warren is very concerned about people losing their jobs while the Fed is doing its job to tame inflation. The second clip is going to be Senator Britt from Alabama, and she's actually got some ideas of things that the Fed can do to decrease inflation. I want you to notice the contrast here.
According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs? And that would be about 2 million people who would lose their jobs. People who are working right now, making their mortgages. So Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
Putting 2 million people out of work is just part of the cost, and they just have to bear it.
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
If there were an increase of energy production in this country, do you feel like that would help drive down inflation?
I think over time, more energy would mean lower energy prices. But we are very focused on what we call core inflation, because that is what is driven by really by demand, and our tools are really aimed at demand.
Right, understood. But I feel like the cost of energy is not just what you pay at the pump. It ends up affecting every good across this great nation. Additionally, I'd like to ask you about labor participation. If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
I think that it would. I mean, remember those people coming into jobs.
Yes.
That would be great, because the economy clearly wants more people than are currently working. It would be great for the country and great for them if they were to come into the labor force.
In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
First, we're going to be looking at inflation in the three sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector. And we need the inflation that's already underway in the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of consumer spending, and more than that of what's currently inflation. So that's one thing we'll be watching that very carefully.
I am Tony DiNarro, working hard, listening to Senate testimony so you don't have to. If you got value out of this, guys, hit the like button. If this is your first time here, don't forget to buy and hold that subscribe button, and I will see you on the next video.